Hello and welcome to this week's BNP Paribas Asset Management Talking Heads podcast. Every week, Talking Heads will bring you in-depth insights and analysis on the topics that really matter to investors. In this episode, we'll be giving you our mid-year update on the state of markets after a very eventful first 7 months in 2025. I'm Andy Craig, co-head of the Investment Insight Centre, and I'm joined today by my co-head and our chief market strategist, Daniel Morris. Welcome, Daniel, and thanks for being here today.
My pleasure.
We've had a lot of tariff concerns in the first half of the year, but equity markets have come through these rapids relatively unscathed. How do you explain that?
Well, Andy, I think about the Sherlock Holmes story. If I may, I think there's one that was titled The Dog That Didn't Bark in the Night. And we've had the opposite. We've had a lot of dogs barking if we think about all the worries that were on investors' minds. Of course, tariffs has been and certainly still is a worry to some degree. We also had the conflict in the Middle East and worries about oil prices spiking to $150 per barrel and what that could have done to global growth. We had all the anxiety about the U.S. Treasury market during the legislation for the One Big Beautiful Bill, when there were concerns that the bond vigilantes would drive Treasury yields to 5, 6, 7%. So all of those things so far haven't really materialized. So all that barking hasn't thankfully been followed up by any biting. Now, any of those three could come back to be a concern for the markets. Middle East is always unpredictable. And even if the bond vigilantes aren't here right now, there's many that think that they have to show up at some point, given the fact that the U.S. does seem to be on an unsustainable fiscal path. And then for tariffs, even though we have had a flurry of deals, there are a lot of details to be worked out. As always, Trump is unpredictable. All of that is to say that it is true the markets have been able to incorporate the impact on profits from tariffs. Even with that negative shock to profitability, there are enough other good things in the market to keep equity prices rising.
We know from experience that when the market consensus is either extremely positive or very negative, it's often wise to anticipate just the opposite happening. What do you think could go wrong now and upset the apple cart, as it were?
It doesn't always serve to be contrarian, but it's good to have that perspective in the back of your mind. Now that we see low levels of expected volatility, positive earnings, improving consumer sentiment, it probably does help to at least think about what could go wrong. On tariffs, we need to recognize that there is no deal yet with China. One imagines China is probably going to be a more formidable negotiator. And then we think about the near-term impact of the deals that have been agreed to. Generally, they've involved baseline tariffs that were higher than most analysts had expected. We seem to be landing on 15%, which probably was not incorporated into analyst estimates, meaning we're probably going to see a hopefully smaller repeat of what occurred in April, which is that analysts had to revise down their earnings estimates for this year and next year to incorporate those higher costs. Another thing to worry about is U.S. growth. We recently got the second quarter U.S. GDP figures, which were better than expected, 3% annualized GDP growth. But that really doesn't give you a true sense of how the U.S. economy is doing. That figure is equally as distorted as the first quarter figure was. If you look at consumer demand, business investment, residential investment, you'd see a slowdown relative to the first quarter. Consumer demand is a big part of the U.S. economy. If, as we expect, we do start to see the impact of tariffs on higher prices in the shops, there is going to be the concern that the consumer weakens further. Encouragingly, on the business investment side, you do see still strong investment in anything related to AI, information technology, software, and so on. The weakness partly came from investment in mines, minerals, and so on.
Daniel, if we shift our focus from equity markets to fixed income, given what's happened over the first half, what are your highest conviction views now for bond markets in the second half of the year?
It's in fixed income where we have the lowest conviction. In terms of just outright duration, meaning where do you think yields are going to go from here for U.S. Treasuries or for German bonds, it's hard to be very certain. And that's because you can think of scenarios where yields could go up. You can think of scenarios where yields could go down, and the probabilities around those different scenarios aren't terribly different. I mentioned the bond vigilantes earlier. Most people feel the U.S. budget deficit isn't at a sustainable level. The question is, how does that change? And one of the scenarios is that the markets do really start taking this seriously. Investors start demanding a higher premium for buying U.S. Treasuries, i.e. yields will have to go up, which increases the interest costs of the debt, and you have the risk of a market panic. A different scenario would be that U.S. growth does recover from the tariff shock. There are other things out there that support growth. We have deregulation. You do see a pickup in M&A activity now. The big, beautiful bill is providing a fiscal stimulus to the economy. We have lower energy prices. All of that could see a reacceleration in growth that would normally correspond to higher bond yields. On the flip side, how could yields go down? I've already mentioned the risk to consumer demand from tariffs. You could see that tipping over, in which case you would see the Fed acknowledging the slowdown and recognizing they do need to cut rates. That would mean lower policy rates, but also likely lower long-term Treasury yields. If we think about the outlook in Europe, one thing that's been a big support has been this expectation of a significant increase in defense spending, also infrastructure spending, particularly in Germany. That raises a question exactly how that's going to be paid for, because no one really sees budget deficits at necessarily such a healthy level in Europe either. One of the possibilities is issuing more debt. All of that should lead to higher bond yields. On the other hand, two things that could bring yields lower. Because of tariffs vis-a-vis the U.S., you're going to see less manufacturing activity in Europe, and there's the concern that China will be redirecting a lot of its exports to Europe, and that would add to disinflationary pressures and hence lower nominal bond yields. All of that to say, we're not really sure. Therefore, the positions that we are taking in fixed income are more on a relative value perspective as opposed to absolute calls on duration.
It sounds like there's another wall of worry for the market to climb in the second half of the year. Can you summarize for us what your key allocations are now, given the outlook that you've depicted for us?
At a high level, our multi-asset team is overweight equities versus fixed income. And within that equity allocation, there's a preference for U.S. equities, but particularly technology, because when you think about tariffs and how that tends to impact goods producers as opposed to services producers, and technology as a whole is a more services-oriented sector in the economy. Within fixed income, no outright duration views, but an overweight of Europe versus the US in terms of sovereign debt, and also a preference for short duration Eurozone high yield debt, where you get a decent pickup versus bonds with a reasonable amount of risk.
Daniel, thank you for joining me today.
It was a pleasure.
That's it for this week's episode of Talking Heads. If you'd like to learn more about our investment insights, please reach out to your BNP Paribas Asset Management contact or check out Viewpoint, our website for investment insights at viewpoint.bnpparibas-am.com. You've been listening to the BNP Paribas Asset Management Talking Heads podcast with me, Andy Craig, and Daniel Morris, Chief Market Strategist at BNP Paribas Asset Management. Please do join us again next time. Until then, take care.
This presentation includes a discussion on current market events and is not intended as investment advice or an offer of products or services by BNP Paribas Asset Management. Please keep in mind that the information and analysis in this presentation is only current as of the publication date.